Welcome to the Private Equity Exchange, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. With over 1,000 delegates, the Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet. Before the events, using our internet platform, schedule one-on-one meetings with delegates that matter most to you, and exchange far more than business cards at your deal meetings at the Private Equity Exchange. Gather great market insight with over 120 speakers and 6 tracks to choose from. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. LBO for professionals, fundraising and asset allocation trends, lessons learned from top fund and wisdom of top LPs.
Thank you very much. What we're going to do is I'm going to just get us started with just a few facts and figures on the current state of the fundraising market globally, but very specifically looking at Europe. And I'll try and get through that as quickly as possible in sort of 15, 20 minutes so we can have the discussion that you've all come for. Now, technically, what do I... The wonders of modern technology. I'd just like to cover the following, really, to talk about current trends in fundraising, to look at that globally, as I said, look at Europe, to give you a 2006 forecast based on numbers up to about midday yesterday, and an outlook for 2007. Really just to recap on some of the underlying factors, what's driving the fundraising market, and we think, you know, the two most important things are cash flow, the net cash flow to LPs, and from that, how LPs feel about it. And look at what we'd call the evolving LP universe. You know, there's an awful lot of change going on there, and we'd like to sort of look at that. Just looking at the global amount of fundraising, obviously back in the early 90s it was you know, very small, but the previous peak was in 2000, when, you know, sort of nearly 600 funds were raised and just over $220 billion globally. That's across all fund types: venture, buyout, mezzanine, distressed, includes funds of funds, and so on. There was then obviously a big dip in 2002, 2003 in particular. But as you're all aware, the last 3 years have been very strong. 2005 was a record, just over 300 billion raised for new funds, and just over 600 funds. As of yesterday, we're already at 540 funds who've achieved a final close this year, and they've raised $360 billion. Based on that, we're absolutely confident this year is going to be obviously a record. In fact, we'll be very surprised if it's not a little bit over $400 billion. So it's grown a lot. This chart looks at Europe now. Now, we can define Europe in different ways, either by the focus of the investments or by the domicile of the investment manager. This particular chart looks at the former, the focus of the investment. So these are funds that are primarily investing in Europe. And you can see, if anything, the growth has been even more pronounced than for the global picture. Europe has been, although still smaller than the US, been catching up. And this year already we're at about just under 160 billion US dollars. We're looking for a total for the year of something like 100 billion euros. I'm now going to go forward a few. Can we go to the next one? Yeah, this is Europe this year to date. I'm just rushing through these quite quickly because we want to get to the discussion quickly. Looking at final closes, this is not geographic focus now, this is the location of the fund manager. So as you know, the UK, the biggest single domicile for private equity fund managers in Europe, already raised about 44 billion. Next comes France, with, as you can see, a large number of funds. Also the second amount in terms of money, at about 8 billion raised so far. Then Sweden, Germany, a lot of funds, reflecting some of the venture funds in Germany. Then Switzerland, the Netherlands, Denmark, and so on. funds by type. I'm not going to dwell on that. If we can go to the next one. There's been an awful lot of talk about, the mega funds, and on a global level, mega funds have been incredibly important and contributed an awful lot of the total amount of money raised. It's true in Europe as well, but interestingly, in this picture, we're over on the right, you've got the funds of above 5 billion euros. They've accounted for roughly 25% of the money raised. It's less skewed towards the big funds in Europe than it is on a global basis. So the bulk of the market actually is down in that 100 to 500 million euros and 500 to €1 billion kind of size ranges. So the mid-market, incredibly, incredibly important. If we can move on. Sorry, I beg your pardon. Back to that's the one. That's the badger. This is looking at funds on the road as opposed to funds closed. So these are people who are still out there looking for money. And I think one of the interesting things there is you'll see just how high the venture line is. So let's go to the next one now. What we're trying to get at here is a kind of supply and demand balance. Over on the left-hand side, funds closed year to date. That's, if you like, the best measure we have for demand from the LPs. So buyout, 50 European funds have closed. They've raised 45.4 billion euros. These are buyout funds based in Europe. Over on the right-hand side is more of a supply of funds. Who's still out there trying to raise money? And you've got 53 buyout funds are still on the road, and they're trying to raise 36 billion. So in fact, already more has been closed, has been raised this year than is out there. Look down at the venture line at the bottom, and you'll see 29 funds have been closed, raising 3.7 billion. Meanwhile, there are 85 venture funds on the road trying to raise 7.5 billion. Now that's quite a contrast. You can't read too much into those figures for various reasons, but there's clearly a very different balance taking place in different parts of the market. In areas like, specifically here, buyout and real estate and mezzanine, the ratio between what's already been raised, the demand from LPs, if you like, and the supply, who's trying to raise money, very different and very much more favourable than the situation is in venture, and to an extent in fund of funds, where it's very crowded, very competitive. What's driving this is clearly at one level just the good returns that LPs have experienced. We think you can go beyond the returns and actually look at the cash flows. Now what this picture looks at, the blue bars, and it's half year by half year, looks at what we estimate the global contributions from LPs to private equity funds. So how much money is being called up. They've made their commitments to all these funds, now it gets called up to the fund. The red bar shows distributions back to the LPs. And as you can see, right up to and including the first half of 2004, the contributions were ahead of the distributions. So LPs they were writing more checks than they were receiving. Since then, the picture has completely turned round. So LPs are making all these commitments. They want to get into private equity funds, and they're making the commitments, but the funds are frankly performing so well that more money is coming back to them than they're paying out. So even if they want to invest more in the sector, their actual investments aren't going up. They're getting more money back, which is great, but there is a frustration in that. They can't reach their targets. What this chart does is it shows just, instead of the contributions and the distributions, it just shows you the net. So above the line there, those red bars are for buyout funds, and that's the net cash flow that LPs have experienced worldwide. And as you can see, buyout funds, even though they've raised a lot of money, have just been churning out the distributions. So LPs, even though they've committed to them, are seeing more coming back than they're paying out. It's the same with real estate, venture, obviously very different, and fund of funds different too. Now, if you put that together with where LPs want to be, which is what this chart is showing, the tall chart there says about 40% of LPs are roughly where they want to be. They've got an allocation of X to private equity, and they're roughly at X. You can see a majority of those LPs, over 50%, are to one degree or another significantly below their target allocation. So they've set their investment strategy. We want to have X% of our portfolio in private equity, and they've made these commitments, and they're currently below their target levels. And guess what? Thinking back to those cash flows, they're not getting any closer. They're getting further away. So the money, they want to invest more, but the money's coming back at them faster than they can commit. And what this one looks at is it then asks them a question, not what's your current allocation, but okay, you've got a current allocation. Do you think you're going to change that? And as you can see, whether you're looking in North America, Europe, or the rest of the world, roughly 54% of the LPs that are on our database say we're likely to increase our targets. 41 keep them the same, even though we're well below them, and only 5% want to reduce what they're allocating to private equity. It's kind of a nice position to be in. That raises a question. Why isn't fundraising easier? With the wind behind the industry, why isn't it easier? There are several reasons. I mean, the first is competition. The total number of funds on the road has just been going up and up and up. As of yesterday afternoon, we're aware of 915 separate funds currently on the road worldwide, trying to raise about 400 billion. We've got a saying in Britain that generals are always preparing and training to fight the last war. To an extent, LPs are always looking to invest in the last boom area, and most LPs are very, very keen to invest in big buyout funds, especially the mega funds. Thinking about the specifics of getting LPs to commit to your fund, one trend that we see in the larger LPs on our database, particularly those who've got more than $1 billion allocated to private equity, and people who may have very extensive portfolios of relationships with 30, 40, 50, 60 different managing firms. There's a real tendency to rationalize the roster of GPs that they have relationships with and to focus on a smaller number of bigger relationships. So that's squeezing out other GPs. There's a lot of churn going on in the LP universe. New LPs are entering the asset class. We've added 500 to our database in the last year alone. And LPs are pursuing increasingly global strategies. As we look at the typical LP makeup in funds, yes, for smaller and medium-sized funds, European funds will typically have European LPs and vice versa. But there's more and more cross-border and cross-regional investment taking place. Just to conclude then, it is quite clear. I mean, 2006 is already a record year for fundraising. It will clearly be the right side of $400 billion globally by the end of the year. 2005 was just over 300 billion. And we think Europe, as defined by funds raised by European GPs, will certainly be 85, probably the right side of 90 billion euros, not dollars. If you measure it, by the way, by looking at funds that invest in Europe, that number would be a lot higher because you'd count some of the big global funds in there. That's being driven by some very powerful forces. It's being driven by the strong net cash flows. The LPs, as we saw, are below their targets. They're not getting any closer. We don't think those forces are going away. A lot of people already called the top of the fundraising market at the beginning of 2006 and thought this year wouldn't match last year. I'm going to stick my head out and say we think next year will definitely be $300 billion globally and quite possibly $400 billion. We don't see any let up. Yes, some of the big guys have raised very large funds, but there's They're using it up. A point I haven't mentioned, I don't have on the charts, by the way, is you hear a lot of talk about overhang. How can they invest all these funds? Well, they are. They absolutely are. There isn't a big overhang. It's 2.5 years worth of investment across the industry, and that hasn't increased. And actually you see some people coming back really quite quickly for the next fund. It's not uniform. As you all know, some areas are very difficult. Question maybe we can address in the discussion, you know, will some of the areas that are out of favour actually be the success stories for tomorrow? And despite all of that, you know, the boom times, fundraising is still very challenging for most firms. There's a lot more new firms come into the industry, and the LP base is changing, and we think connecting with the right LPs is increasingly difficult, but increasingly important.
I wanted to ask both these gentlemen some question first on fundraising, and I mean, you talked about this complex relationship between LPs and GPs and how it evolves over time, and that right now LPs are I mean, they're looking to even more commitment, and we don't see it ending up. So just to bounce on what Mr. Luasaga was telling us this morning, opening up this discussion, do you agree that this is an industry where the supply creates a demand? Would you agree with that?
I don't think it's the more funds there are, but what clearly has happened is that in the last couple of years, the very large investors in private equity, namely institutions, bank, insurance companies, have decided that they will continue to invest in privately, continue to put more money at work, but focus on less funds. And that's a big engine to those mega funds. Because if you have a minimum investment of $500 million, and you don't want to be more than 10% of the fund, well, you need to find a pretty large funds to be investing in. And that's really what allowed the creation of those mega funds of 10, 15, probably $18 billion, which doesn't really make sense if you think of the pure nature of private equity, which is to invest primarily in private companies. Once you have those sizes, suddenly the universe of private companies becomes much smaller, and you end up doing public to private. You have to buy public companies to be able to put as much capital at work. So there's a real shift, but I think it's, again, it's more the consequence of supply. If there's more money to be invested, the funds will be very happy to become larger. Because it's also, I think, one big shift is that private equity has become much more an asset management game for the large funds. Mm-hmm. Because if you have $15 billion and you get 1.5% management fees a year, it's $225 million a year. That's a lot of money just to manage it. So suddenly the incentives have changed from creating great performances and to be paid on the carried interest, on the performance fee, towards gathering many assets and making sure that you can raise next time a fund of the same size. And that also is being possible because the same large investors that want to invest a lot of money have lower return expectations. They're quite happy with maybe returns of 15%. So there is, I think, return expectations, amounts of money put to work, and the fact that GPs are very happy to manage more money is one of the explanations of the trends we're seeing.
All right, and yeah, and as to me, this capital deployment has also been driven by a great push in the M&A market in the past quarters. And I mean, you were mentioning the P2P trend, and we've seen that Blackstone, which is one of the largest funds out there, is now has bought 4.5% of the Deutsche Telekom, which illustrates that example perfectly, I think. Well, just to come back to the fundraising process and how you were doing it, I was just interested to see what was your opinion on the placement agents versus doing it in-house. I mean, what would be your selection process, for example, Thomas?
Yeah, I think placement agents have gone through a shift over the last few years, actually, in the business model, how they operate. For placement agents today, it is first identifying what they would like to place, and that's a hell of a job, and then pitching for, you know, who they can get and who they can place money for. If they do it for funds who may not have a good track record or may not have a track record at all, then it's a very difficult venture, which requires a lot of energy and a lot of very well positioning of the management team. If they do it for very successful funds, then they're being squeezed, and that's where the main actually impact is coming on the business model. That's where they're being, I'm not saying abused, but where they are being used for things they have historically not been doing. They're today placement agents acting as sort of, like in a direct deal, if vendor due diligence is being provided, that's what a placement agent does today for a very successful fund. They're basically doing the entire due diligence. They're establishing all the documents. They're getting all the track record lined up and put nicely in shape for limited partners to analyze it. And that's basically what they're being paid for. It's an outsourced service purchased by successful general partners. Now, whether you're going to do it inside or outside, I think it's maybe a little different for direct funds and for fund of funds, but I think it ultimately depends what you try to achieve with your fundraising process. If you want to broaden venture into new investor bases, which you haven't been tapping before and where you don't have a network, then you may use a placement agent actually for a particular region, be it the US, be it Europe, wherever you're sitting. That's one dimension, I believe. And the second dimension for a fund of fund, or a fund who is generally captive, i.e. sponsored by a bank or other financial institution, they would normally just look at the network of that institution and then also selectively either use a placement agent or just use the sponsor to do the placement for it.
But the environment is changing very fast. I mean, you were mentioning how much new GPs are entering the game nowadays, and I mean, how do you deal with new talents, and how do you assess those new management team if you're doing only through your network? I mean, aren't you limited in that aspect then to just your existing network and because sorry.
I think you have to look at it, from two angles, investor and investments. If you look at investments, you would hopefully expect that the decent GP, whether he's doing a fund of fund or a direct, has a very clear strategy, is uniquely positioned to exploit that strategy, or has been showing in the past that he can exploit that strategy. And then, it's probably the reason why investors put money with him is because he has shown or convinced at least the investor that he is the right guy to know this particular segment, or if it's a global strategy, the globe. That's on the investment side. On the investor side, it's, I think, again, some ones who are very successful, I don't think they need a placement agent if they don't want to substantially broaden their investor base. If you want to venture into new areas, you will probably have to use one, except for the most highly visible names who limited partners just bang in the doors just to be present there.
I think if you look at all the funds that were raised last year, you find that approximately 1/3 of them used placement agents and approximately 2/3 didn't. That's roughly the statistics. And there's actually kind of a pattern of whether, in a sense, concentrated to a degree in the middle of the market. At the very top end of the market, the biggest funds, as you say, there's a very clear trend that you mentioned, that GPs are seeing themselves as asset managers as much as investors, and therefore they have two strategically key tasks in their business model. One is the investing of the funds, the other is the gathering of the assets. And you're seeing more and more of these, the really big firms, professionalizing their investor relations functions and recruiting investor relations professionals, having an investor relations partner, and raising their game in that area, and having a team in-house who can do, frankly, everything that a placement agent can do, but they're getting closer to their investors and that kind of strategically important part of the business. Down at the bottom end of the market, for smaller funds, for first-time funds and so on, frankly, the economics are far less attractive for the placement agent. It's just as much hard work to raise a 50 or 100 million euro fund as it is to raise a larger fund, doubly so if it's a new firm. And so a lot of placement agents, certainly the ones who can pick and choose, won't be working for smaller firms. So yes, the role of the placement agent is changing, but also I think their core is in the kind of in the middle market now, not in the smaller ones, because it's not profitable for them, and not at the larger end, other than for perhaps a very specific mandate. Help us with Middle Eastern investors or whatever, but certainly not a kind of a full mandate.
And actually, just most recently, in fact, there has been an emergence of a new type of placement agents, in fact, which is the investment banks have historically been starting this as real placement agents. The big bulge bracket players have been doing it, placing privately. But now we have seen a few mega funds coming with stock quoted projects, where obviously investment banks, the capital market, has become acting as placement agent for them, at least for the tranche which is being publicly listed.
Okay, and now if we analyze the deployment of those mega funds, I mean, as you mentioned, this leaves room on the mid-market for maybe small funds, and and you mentioned what was the amount of investment in ventures, for example. So is this really where the growth lies nowadays, according to you?
The assumption is probably that the returns from mega funds will be lower, because they're putting. It's much more difficult if you invest 5 billion to double it in 5 years, and the number of opportunities is smaller as well. So they are in a difficult situation now to offer high returns. They can still do it because of very attractive interest rates, and they're getting very good at structuring. But that also bears some risks if there's a downturn in the economy. So I think that we would expect smaller funds and also venture funds to probably, the better ones, to have quite good performances, because they're in a situation where they have many more opportunities and less competition to some extent, because there aren't so many venture funds, for instance, left in Europe. There's really has been a huge attrition after the burst of the 2000 bubble. And as a result of this, the ones who survived are fairly good ones, and now they can really pick and choose from a large number of investments. So I think it's probably interesting and maybe good to be a bit more contrarian in terms of investing, depending on what your return targets are and depending on how much capital you have to put at work, of course.
There's some very interesting issues about the big funds. Looking forward, that might well be the case, and we might well see it becoming increasingly difficult for the largest funds to have good percentage returns. However, historically, if you look either within the US or particularly within Europe, and you look at fund-by-fund performance, generally speaking, the larger funds in the buyout area have actually, on average, performed better than the smaller and mid-market funds. That's a fact. Now, your point, Raïner, that there will be good smaller funds who will deliver returns that the biggest funds simply cannot, is absolutely true. There's no doubt about that. But somebody once said that, percentages don't pay the bills, and they don't. So IRRs don't pay the bills, they don't fund the pension deficits, it's cash-on-cash returns. So if you can get a slightly lower IRR, but put 500 million to work, that has its attractions. There's been all this growth in fundraising. If you actually, however, look at it by size range, and this may be more true in the US, but it's also true in Europe, the actual growth of funds raised in the mid-market has been there, but it's not been as stupendous as the overall growth. The overall growth has come from the biggest funds getting much bigger, and it's like, we used to have an advertising campaign in Britain for Heineken, the beer that reaches the parts that other beers don't. Well, this is private equity reaching the parts that, that other funds don't. It's the biggest funds, going in to make acquisitions and investments that simply wouldn't have been made by private equity funds, certainly 5 years ago, even 2 or 3 years ago. When you look at the historic outperformance, and I accept that may not be the case looking forwards of the larger funds, we don't really know what's causing it. Is it because the larger funds, have better management resources and better processes, or is it because, if you look at Europe today and ask how many different funds can bid for a 500 million euro asset and how many can bid for a 5 billion euro asset, you've got a handful versus 50. So that there is a kind of competition element there as well.
But there's also a shift now. I mean, if you see historically, those big funds have been doing mostly financial re-engineering, and nowadays they're shifting more to also operational re-engineering, and you have M&A bankers coming into play. You also have operational managers joining in. So yeah, I mean, they're becoming asset managers, but they also they tend to become more than that, also, or restructure, I would say, or.
Well, I think they have to. I mean, if you look at how money gets created in private equity, there's different stages. The first stage is to buy at a low price. I mean, that's of course the good start, which now is very difficult because prices are very high. Second stage is to do some restructuring, selling some assets, which again is pretty more difficult now because companies that buy those targets all know that you could do that, and therefore they put in the pricing. And then what is left is financial engineering, and I think they're all quite good at that as well. And definitely the almost last point is to really create value by having the revenues of the company grow, but most of all the EBITDA of the company grow, which requires other skills than typically large funds had, because most large buyout funds came more from the investment banking side. And then the last way to make money is if you're lucky, and then the multiples at which you can sell the company is higher than the one you can buy it. And again, this looking forward is not obvious because we're at very high multiples now, so it's not so clear that they will increase further. So they really have to work very hard on operations. I think that's very true.
And maybe yield-hungry institutions shouldn't be betting that private equity funds will be the only growth areas for the futures. And in terms of allocation, I mean, you were showing up that 40%, I think, were happy with their current allocation of private equity. And I don't know, is that your case? Are you currently happy with
we only do private equity, so we don't we don't allocate to other assets.
Okay, so all right.
So Raïner made a very interesting point earlier about the effectively alignment of interest in the big funds. I think one of the reasons private equity has done so well historically has been that, as opposed to public markets, it aligns everybody's interests really very well. It aligns the LP's interests very closely with the GP's, and the GP's very closely with the manager in the company. And so everybody's focused, like a laser beam on the same objective and the same output. And, as you say, Raïner, when you have 225 million coming in, no matter what, there has to be a question, does that change the balance of motivations? I think as an LP you can probably trust the biggest firms with the best track records, but the question should be asked.
Let's be a little controversial on buyouts, large versus mega or mid versus mega. If you look at the current environment and the last few years, obviously it's relatively clear that the mega buyout funds have benefited most of the environment. If you buy a deal in that segment, you're in a position to most highly leverage it compared to any mid-market buyout fund, which would normally maybe leverage 50-60% of the deal, while we have seen most recently in very large deals 80% and more, depending on what kind of structures you're applying. So coming back to what Raïner said, financial leverage is one possibility to create return. I think that's what they have been doing very well, and that's what they have been highly benefiting the last 2 to 3 years. If that would be excluded, I think the performances would look quite different. Now, The second layer of creating value is doing operational improvement, move the company forward strategically, whatever you try hard to do it. I think there, and also this looking a little prospectively, it is very hard to move global businesses, forward on an operational as well as on a strategic level in a market where stock exchanges appreciate, or in general strategists also appreciate clean assets, focused on the core business, whatever. So therefore, strategically, how to develop a company further, which is already global, distributes its product all around, has clients all over, and does it very well. It's relatively difficult, operational. There can always be a few things done. But I think, if you then look at the other end, the small to mid-sized companies, and you look at it particularly in the European Union's context, what's going on there currently, I think there you will find that you will have plenty of potential to do these kinds of things. Because they haven't, in most cases, been done yet the companies are still around. Which would, I would argue, makes it all the more promising, that the small companies and the mid-sized companies actually have much more potential to further develop, particularly again in the European frame overall. So my conclusion, and that's why I said be a little controversial on it, the mega buyouts, they have been over a very long period historically always been performing extremely well during these kinds of cycles, which we just experienced 2003 to 2006, even more and more aggressive. If you look at these days, they do a deal, they half a year later or a year later, they re-leverage, pay out a super dividend, and go off with the asset basically for free, and try to realize then a significant capital gain in the second round. I think if just a few things from a macro point of view will change over the next 12 to 24 months. I'm not saying that we see a bloodbath as we've seen in the venture, but we might see certain corrections in that area, which will then, again, hit the mega buyouts most, because they were also benefiting most of the most recent trends the last 2 to 3 years. So to come then back to the other side, the small and mid market segment, I think that's, while maybe even 4 years ago it has even been better place to be, it is still a good place to be right now.
I would like to pick on what Raïner said a bit earlier, which is a lot of LPs today, or some categories of LPs, do not expect more than 15% out of private equity. I guess my question is, well, do you know categories of LPs that I would like to stick to the, 40% and above type returns? And thirdly, what are your expectations?
Well, I think that the private equity industry has changed dramatically over the last 20 years. I mean, if you look at how it started, I think the first KKR fund was $20 million. Now they're at 15 billion. And in fact, they had a lot of difficulties raising money at all, and they raised money from private individuals. This is how they got started. And those individuals had pretty high return expectations. And I think that what is happening now is that it has become a much more, a very large portion of investors are institutions, and they have today more the problem that they have too much money to invest, and they want to find good ways to invest it, and then are willing also to accept lower return for the risk they're taking, also for the illiquidity, because you are locked up for 10 years. And if you look at it, 15% being locked up over 10 years, it's okay, but it's not great. But to get back to Thomas's point, if you buy the S&P for 10 years and leverage it 5 to 1, you beat all those funds all the time.
Well, that's why would LPs continue to lower their expectations?
Well, because it's not totally rational, but no one said that the financial world is rational. I think that if you look at stock markets, they don't behave rationally. Investors don't behave rationally either. In the end of the 90s, everyone wanted to invest in telecom and IT, and everyone thought it was great and thought that the internet would change the world. And everyone did that, except Warren Buffett, of course. But that's the world in which we live. And I think that if large institutions sort of collectively decide that they want to invest in the asset class, that it is becoming an important part of the asset allocation, and at the same time they don't want to invest it at 5 million a time, but at 500 million a time, they have to end up investing in large funds. I mean, maybe they don't do this investment decision consciously, knowing that they may get lower returns, but they will probably end up getting lower returns.
I think people who are probably not willing to compromise on performance are ones who offer a business which actually for their own success requires high performance of the underlying managers. Typically, you would obviously then argue a fund of funds. If you calculate the business model through a fund of fund manager, he would normally probably want to see 2 times net to hit his accounts, so that for him, there is something at the end of the line to distribute as well. Else it's a pure, management fee-driven structure and doesn't help an awful lot for his own business to make money. I think those people would probably not compromise. On the GP side, it's clear, those GP are not willing to compromise, who can live with the management fee, but who are not going to get rich with it. So I don't need to tell you who those guys are. Then I think on the investor side, there are obviously different expectations. Pension funds, who have gone through the proper asset and liability studies, knowing how much needs to be set aside or can be set aside for long-term investing, I think they generally tend to be fine if they see 10%, because the ultimate decision takers on the asset allocation and on the performance measurement are not private equity specialists. They just say, okay, 10% sounds good, let's go for 10% in the allocation. So I think as a conclusion, you have to look at individual investor categories on the one side, and at the other side, and that's also important, which gives an indication where you should probably put your money, is the GP himself.
I mean, one comment I'd make is when talking about return expectations, I mean, people may have 40% or 30% return expectations. In no year ever has even the venture industry, the median return hit that much. So LPs as a whole have not experienced that. They may have experienced a high return on a particular fund, just as I did yesterday when I put £5 on the horse in the 3:30 at Newmarket. But it's the return on the portfolio that matters. And I think most institutions, if they thought they could really get 15% net across their portfolio, would be very happy with that and should be. Really.
So they should not over allocate to that asset class, right? Because that would be realistic.
I think they shouldn't under-allocate. I think if people have a desire for a 30% return and think that private equity is looking forward going to return 15%, I think it would be a huge mistake to get out of it.
Yeah, definitely. We have a lot of time for another question, if there is any. All right, so I'd like to thank you all on this panel. I'd like to thank our speakers for coming today and expressing their views on fundraising and asset allocation. Thank you very much, and that was a pleasant discussion. Thank you.